Okay, good evening guys. Before we get started, let's do the customer instant poll. Let's check you can all hear the volume correctly. Put it in your screens now. Let me know if the sound is perfect, too loud or too low. Standard settings for me, so it should be fine for you guys. Okay, Anil's quick off the mark. So is PJ. Cheers, Phil. Alright guys, excellent. Okay, so advanced candlestick formations, very important. Markets are about as tough as they've been for a long time, to be honest. So understanding your actual kind of key technical formations within the candlesticks, be on the different time frames, is very important because the odd doji here, the odd hanging man here, the odd reversal pattern, continuation pattern, really can give you that confidence of getting in a position or not. So I would say, really, for me, it's it's like everything. I mean, I could basically just send you my book and you don't have to learn anything else. Obviously, with the live trades, like I'm going to do tomorrow, non-farm payroll, they're all different. There's only so much I can kind of really portray and give you guys. There's only so many things that work. And it doesn't matter if you're, a retail trader, a fund manager, a swing trader, scalper, whatever it is, it doesn't really matter. There's only so many things in the markets that actually work. And that's a combination of the self-fulfilling prophecy and the fact that human beings are human beings. We only know so much. The first mistake most traders try and make is try and figure out a formula, a strategy, a way of trading that nobody else has thought of. Trust me, if you've thought of it, I've thought of it. And if I've thought of it, the entire world has thought of it. That's the way trading works. The best thing about trading is to try and do the basics well. That's where you're going to make your money. That's where you're going to understand your place in the market. And that's why you're going to make your money. So before I start, as always, the risk warning. Remember that spread betting and CFD trading can have high risk of capital, the possibility of losing more than initial investment. These products may be suitable for all investors, all intended for people of the age of 18. Please ensure you're fully aware of the risks involved and necessary to seek independent financial advice. And again, remember, it's educational only. The content of the webinar is a personal opinion of the moderator, not intro.com. The content is not constitute financial investment or tax advice. Your advice discuss your specific requirement with an independent financial advisor prior to entering any bet. Intro.com is not responsible and disclaims all liability for the content or comments made during the session. So why use advanced candlestick patterns? Why use candles at all? Every time you see a chart on the news, you'll see a Bloomberg chart. It's very distinctive. The kind of orange background with a blue chart, generally kind of infilled with blue, and they're a line chart. So things go up, things go down. Now they show you that because that's what people in the real world think they understand. They understand things going up, understand things going down. Really, if you get into the nuts and bolts about trading, you have to understand why things go up, why they go down. And not even that is actually how they get there. The way a market gets to where it's going is actually the key to understanding trading. And really, candlestick trading for me is the only way to understand that. In my early days, and I'm talking 15, 16 years ago, I was a big believer in market profile. Big believer because I didn't know anything. I was a young lad. I was a kid, and I followed what people told me. And back then, the markets didn't have a 2, 3, 400 pip range. We were trying to bell curve on a 50, well, probably less actually. Trying to do a bell curve on a 25, tick, bund or T-note or something. So the market's just absolutely nothing in comparison to what they are now. So understanding markets in general is not that they can go up, they can go down. We all know that. It's understanding how they get to where they're going. That's the real key to understanding markets. And I think individual candlestick patterns are a big way of understanding that, but also advanced candlesticks and understanding patterns, understanding collections of patterns. These are the things that are very important because we can all identify a doji, but it's when to identify it, isn't it? It's when to identify when a doji is going to be useful to you. At the end of the day, markets go up, markets go down. That we know. It's how they get to where they're going, and it's a reason why they've got there, and the kind of characteristics that they've got there. That's what's going to help you understand the market and understand how to get into a trade. Now, again, comments at the ECB today and things have sent the markets wild. It's as difficult as trading has ever been. I'm not going to lie to you. Even I am finding it very, very difficult to trade these markets because I'm happy with risk. I can take risk on all day long. But if I'm risking, a minus, 5-to-1 ratio just to make any money, then I know everyone else is suffering, and the markets are tough. So I think the individual candlestick patterns and real trigger patterns are a good way of giving you some sort of edge and some sort of understanding. So if you can get the basics, then you've got a chance. Because I tell you what, guys, if you don't have the basics, then you have no chance of making money in these markets. So I guess before we begin, there's a couple of things that I like to remember when I'm teaching anybody, I'm talking to anybody, and even when I'm trading myself. It's that the points below really need to be adhered to. You can't always be flying at the seat of your pants. Some things have to be gospel. And candlesticks are just that. They're gospel. If it's a doji, it's a doji. If it's a hanging man, it's a hanging man. If it's a shooting star, it's a shooting star. So it's not open to interpretation. It's not if or but. We're dealing with absolutes. And that's a really good starting point when you're talking with trading. Because, again, things like indicators and oscillators. Think about RSI. What, do you buy RSI at 30, 28, 27, 20, 15? What is to say what is overbought and oversold? With candlesticks, at least the one thing, they're an absolute given. There are several candlestick patterns and different ways interpreting patterns, but they are what they are. If you look through Steve Nissen's candlestick books, which I did when I was a young trader, a massively overrated book, but it is what it is. They are what they are. You can find out 10, 15 candlestick patterns that you will see every single day in a chart. So I guess it's understanding confirmation, what actually works, what is a real signal, what is really worth paying attention to. And then it's, again, understanding what suits you. Just because, someone on Facebook says that they trade X, Y, and Z and that always works, listen, if there's a guaranteed pattern every single time that works, then nobody would tell you about it because they've been making money in the markets themselves. At the end of the day, it's all conjecture. And that's everything I teach you. It's always about figuring out what works for you. And it might not be candlesticks. It might be Bollinger Bands. It might be Elliott Wave. It might be Fibonacci. It might be one of the million things that InterTrader pay me to teach you because I don't know. Okay, I don't know what's going to work for you. I know that if you don't know all the elements of the equation and you don't understand yourself, you're very likely to fail in trading. So what we're trying to do is always give you some viable options. I would think for me, there's certain things that just work. And again, these are kind of a combination of things that work with formation, individual candle patterns, etc., etc. And I would say that there's no point trying to go against me here. It's not that I know more. It's just I've selected these things because I've traded them for 15 years. I've watched people lose considerable amounts of money trading against these things, and it's just a numbers game. I've just done more hours in front of the charts to know what does and doesn't work. So for me, it's all about the bullish bearish kicker, island formations, which we've seen today, cluster island formations, bullish and bearish flags, wedges, symmetrical triangles. So I guess it's really a combination of candlesticks, but also actual technical patterns. And technical patterns can be made of obviously bars and I guess even line charts. But really, what we're trying to focus on today is it's not just the fact that patterns work; it's the fact that candles within patterns really work, and that's why it's a little bit more advanced. So we're looking for a bullish kicker. Now, I mean, again, when I do these examples, it always looks absolutely obvious. But I mean, you've got to think about the time frame you're looking on, what's happening in the markets, the fundamentals. If you're looking at this on a non-farm payroll on a minute chart, is it significant? Probably. If it's on a monthly chart on the Dow, is it significant? Probably. At the end of the day, it is something that's happened in the market. Something's happened to stop the market selling off, and it hasn't just bounced up. It's bounced up with a gap, and a gap that hasn't been closed, and that's a bullish kicker. So it doesn't make any difference how you interpret it. It means that something was happening in the market that reversed. Okay, and that gap is all important. Very much like my gap trading webinar, which again I'm going to do back in January, is very important to understand that if a gap happens in the market and stays in the market, remains in the market, something serious has happened. And in the rough guide to trading, I spent a whole chapter on the book on gap trading because intraday or bigger time frames, there's no better signal what the market's trying to achieve than when you see a gap. And we saw it in the euro dollar today after the comments at the ECB, and the market gap down. It was something like 7 ticks, and after that 7 ticks, it didn't close the gap, and it sold off continuously for another 100 ticks. Now, if that's not a great signal, I don't know what is. Then, kind of reverse is a bearish kicker. So that is when the market's very aggressively up. And all of a sudden the market, again, gaps back down, comes to the low, and doesn't retrace. The whole point is, when a gap doesn't retrace, something's happened in the markets. As I've said, it's either fundamental, it's either technical. Generally, when we see gaps, the fundamental, there's something new coming into the market. There's something new coming into the market that's making people buy or sell in a different way. That's how gaps exist. If you see a technical gap, they're generally very small, and you see them on the smaller time frames because it's generally the market trying to bully prices around, but they're generally then very close very quickly and aren't around that long. So again, all these things you need to be aware of. I guess continuation patterns with candlesticks are, I would say, probably one of the best examples. If you want to see a continuation pattern, then you drag up any, and I mean any, daily, weekly, monthly DAX chart, or you drag up any daily, weekly, monthly gold chart. DAX, it goes up. Gold, it goes down. And that's how you understand a continuation pattern. It does something consistently through time. And I'll tell you what, if you just bought every low in the DAX and you sold every, I guess, significant intraday high in gold over the last 18 months, you would be doing very well for yourself. So things you need to look out for. It's not just the candlestick patterns, but how they get there. And that is, for me, pennants, triangles, flags, and wedges. These are all, I don't know, this is, again, it reminds me of some very boring books I read when I was a very young trader. But they still have a place in the markets. I was very against, kind of things like pennants and triangles and flags and wedges because they seem too obvious. And the whole point was they are obvious. And the whole point is that's why they're self-fulfilling. The point I missed was that the market uses these things to manipulate extremes, and it's not about it being a pennant, a triangle, flag, or a wedge. It's the fact that it could be or it couldn't be at any given time. And that's the really, really, really beautiful thing about technical analysis, is we can all see the same thing, and in hindsight, we're all perfect. How many times have you bought and sold the high and low of the market and got stopped out? Yeah, because that is the whole point. Yeah, markets understand everything you know and throw it back in your face. It's all about being right. Yeah, at the right time, not being right. And I've told you this since day one. So I guess anything you need to remember is really with any of these kind of continuation moves, there'll be a start, kind of an inception point. There'll be some sort of, big spike, some sort of movement. Then there'll be some consolidation, a breakout, a new trend. Now, if you've seen me trade any non-farm pair, which I'm sure you have, I'll do that by the Fibonacci. So the initial 5-minute candle, we understand the high and low, understand the 50% point of interest, and then we trade around that point. Not rocket science, is it? But when things are moving around the way they do, and very aggressively, it's not as easy to say, what's the high, what's the low, what true value is. So again, when you talk about technical trading, it's understanding that technical trading is that it is technical. So it is what it is. There's no interpretation. You have to figure out the high and the low, and if you get it wrong, you're probably going to lose money. So this is again another very basic example, to be honest. We see an initial move, the market's gone down. I mean, if nothing else, you can see more red candles than green. That's how you know that it's going down. There's more lows than highs. I mean, it sounds like I'm teaching you guys, the absolute kind of, numpty kind of, trading. But how many times do we forget the basics? We're buying low, we're selling high. How many times do we forget that? If a market wants to go down, why are we buying here or here? We should be selling into that weakness. So the market moves down, it's clearly a very downward move. And then we hit 2 points of support from the low point here, 2 points of resistance. So we don't know anything that happens, I guess, after that vertical line. So if you don't know anything that happens, what we're going to do? Well, we're going to figure out what happened in the past and use that to predict in the future. So we take our line of support to the next point, resistance, line of support to the next point, And again, we don't know anything that happens after this, but the trend is down. Okay, the trend is down. There's no other trend involved here. Consolidation. The market then again false breakout, but then comes down and makes these new lows. So what happened in the past will happen in the future. It's all about figuring out when and what that will be. That is it. That is the art of trading, and that's what I've tried to portray in the 1,000 webinars I've done, in the many years I've taught trading. What I try and do every single day is try and find some value. Buy low, sell high. So then you've got other formations that generally, kind of come across your screens in wedges, and that's rising and falling wedges. And really, that again is just to emphasize what's happened in the past will happen in the future. So again, it's not to overcomplicate these things. When you're looking at something to give you an idea of what's happened in the past and the future, look what's happened in the past. 1, 2, 3, 4. Okay, these are all extended candles for me. All extended candles, much bigger than probably what's happened in the past. I don't know how to see the rest of the chart, but I'm guessing they are. But when you hit the highs and lows, the market tells you what it wants to do. Obviously, we get a breakout here, so what? You're always going to get a breakout because Goldman Sachs, UBS, Deutsche Bank will say, yeah, we're definitely going up here because I know what's happened in the past. So I'm going to get some more lots in here, let the market, find some support, and then break out from the top. What happens in the past will happen in the future. So think about, again, this kind of elastic band theory. As things wind up, wind down, they're going to wind back up in the next way. So it's not even the candlesticks sometimes, but I really do think they help. And again, when you see 4 massive candlesticks, all green, it's already told you what it wants to do. It wants to go up. Can you argue against that? No. So when it finds support, as it does here and here, then buy it and wait for that to continue. That is what it's all about. I guess symmetrical triangles are good because they are symmetrical. I mean, it doesn't matter if you failed GCSE maths or not. Symmetrical triangle is basically 2 points coming to a point and equidistant apart. If you don't understand that, then you need to basically, well, I guess just undo your PC socket and start licking the plug. At the end of the day, it's not difficult. But the thing that makes it work is that it's self-fulfilling. So if I can see these points here have been resistance, these points here have been support, I know somebody else can. So as it moves through the chart, I can see other people looking for that. So as it breaks in the initial direction, that's it. But it's the confidence, isn't it? It's being patient, it's waiting. It's buying here and the market going to here. It's, buying here and letting the market go to here and then come back down. It's holding on to what you know is going to happen, what is absolutely inevitable. It's that element of timing. And then bull flags, again, are another formation I think are very underrated. We see these same, 4 big, strong green candles, and the market comes down in a uniform way. And the fact that it's uniformed, that's when you know something can happen. 2 points of resistance at the top, 2 points of support at the bottom, then the market again goes down equidistant, which again is very important because that means algorithms, that means other traders are looking at that pattern, and it breaks the upside. So look for things that are equal, look for things that are structured, look for things that make sense. And again, the bear flag is just exactly the same. We see a downward movement, we see 2 points here where the market finds support and resistance, then it carries on. And then what does it do? It carries on the way down because that is the initial way we've seen the market move. And you can make these things as complicated or as simple as you like. At the end of the day, it's down to you. It's interpretation. That's what makes all these things so massively difficult because you might see it and think, oh, I don't know, that's a bit too obvious, isn't it? Well, by the time you thought that, the market's already acted. Now, I think island patterns for me are a bit more conclusive because they really interpret movement, they interpret gaps, fundamental, and a bit of technicals. So when we're looking for island movements, we're looking for some sort of significant reversal or continuation. So in this market here, the market's moved up, it's tried to move down, and then at the top of the range, we've seen a gap. Okay, that's an island. It could be a 1 minute chart, 5 minute chart, 15-minute chart, hourly chart. You generally, unless you're looking at all time frames, don't see gaps. Gaps generally appear intraday on the 15-minute chart and below. You see a lot of gaps on 5-minute charts. When I say a lot, you probably see 2 or 3 a day, which is a lot. They're not like the markets used to be. So again, what you're seeing is the market moving up, hitting a high, okay, leaving an island formation with this individual candle, then moving down, a big reversal. So anytime you see that kind of thing where a candle or a group of candles left on their own, that's a massive, massive signal. Now this again is an indication of continuation. The market's moving up, bit of profit taking moves up here. Then we see one candle again left in its home. Okay, but the market doesn't retrace this time. It doesn't look to move down. It goes up, so it continues in the original direction. So this point here, from the high to the low, if you see a gap above and a gap below, is massively important in the markets because gaps are hated by technical analysis. They're hated by algorithms. They're hated by normal traders. So understanding that when a gap exists in the markets isn't closed is of massive importance. Now it comes even more important when there's a series of candles, because if I know the market's going up here and we see a gap, right? If that doesn't close for 1, 2, 3, 4, 5, 6, 7, 8, 9 candles, then something significant has happened in the markets. Something absolutely significant. If it can't close in 9 candles, it can't go up, it can't go down, but the likelihood is it's going to continue in the original direction. And then you see it gap up again, well, you just buy. You buy and you hold it because there's absolutely no way, yeah, with a gap here and a gap here, this market can't then go down. It has to go up before it goes down. That's how charts work. And gap formations, cluster island formations are probably the most important pattern you're going to see in a market. So I guess, when you're trying to figure out trading advanced candlesticks, you need to sharpen them up. And that's generally done with oscillators and indicators. So indicators, oscillators, the same thing. An indicator is something that's outside of the candlesticks. So an indicator is something that is like Bollinger Bands. It shows you overbought and oversold. An oscillator is exactly the same. It just has a scale between 0 and 100 or 0 and 1. So that's the only difference between an indicator and oscillator. Pretty simple. So I guess the most simple indicator you're going to see is moving average. Now, again, going back to basic maths, moving average is a sample of data over a period of time, and it shows the average move. So when this market here, tries to get above it, it goes down. When it finds support, it goes above it until it breaks and goes down. Now, obviously, if that trading was that simple, we'd all be millionaires, but it's not. It's all about understanding the individual elements that make up a chart. So for me, two oscillators probably wouldn't be the 2-day moving averages that I put here. They'd probably be maybe a combination of a moving average and an oscillator RSI or demarcation. But at the end of the day, I can't tell you what. That's only what I'd use. What you can use is a combination, maybe a 20 period and 50 period moving average. So when they cross here, you get an example of what could happen. Across here, something could happen. Across here. It all depends what works for you. I can't tell you what's going to work. I'm just trying to tell you that if you work with candlesticks and oscillators, things can happen. So in this particular instance, bullish hammer, the market rejects a move down after this big move, gets above the moving average, then really doesn't look back for another 25 candles. Now, if that's not a good combination of signals, a hammer, and then to wait to close above the moving average and then 25 candles later you're up, if that's not a good indication of how to make money, I honestly don't know what is. So again, the RSIs are the good ones. So we see the market move down. The market then reject with this hammer formation. Then the RSI move from the low point and only go up. And that again drags the market up until we then start to sell off towards the end and come back down. So maybe RSI, moving average, and candles are a great combination. Again, it's almost impossible for me to say. But again, it's for some of you to figure out for yourself. And I guess disadvantages of oscillators are that there's so many. I've written 3 pieces of software. I've written a book. I've traded for 15 years. And I have 84, I think, at the last count, algorithms. I don't know what the perfect combination is. I don't know. And I wouldn't dream of telling you. And it doesn't matter what I tell you because it doesn't matter what it is. All you got to figure out is what you look at, what you think is important, and what makes you money. And that can be the RSI, Bollinger Bands, that can be the demarcator, and your moving average. it can be anything. It can be absolutely anything. It's not for me to say, but you have to figure out what works for you. And I think anything you do, oscillator and indicator wise, has to be based around candlesticks, because it's that individual candle, that group of candles, that island formation, cluster formation. That's what makes all the difference. I think using multiple oscillators is great, because you get more information, but there becomes a point where you have too much information. How many times have you seen people on the internet, show you a screen, it's just a blur of lines and dots and etc. etc. There's only so much you can actually do. Okay, so for me, I would say candlesticks, 2 indicators, some sort of moving average and Bollinger Band combination, and 1 or 2 oscillators is perfect. You know, any more of that in your chart, you're trying too hard. Okay, your individual candlesticks will be there for the actual entry point to the kind of confirmation of direction. That's what they're there for. So again, I'm going to go to an example here of how you can do things and try too hard. I mean, look at this chart here. Just candlesticks on their own. What would you do at A, B, C, and D? Would you buy? Would you sell? What are these individual candles telling you? Well, for me, this is a doji, so that's at the bottom of a selling. So I'll probably buy it. Get stopped out. Hammer, yeah, probably buy it because it's the bottom of again, but I've already been burnt. Buy it up, would have made some money. C, hammer, no, that should come down, goes up, and here again, market sold off. Indecision doji, every chance of going back up or going down. So for me, I only made one winning trade, I think, out of that, and it wouldn't have been very good either. But then when you start to kind of go through and understand what it is, it's a doji star, a hammer, a shooting star, an engulfing pattern. We actually put that with the kind of overall trend and some oscillators, you get an idea. So again, we can see that we don't know the future, but we know this much. So everything after the right hand side we don't know, but we know everything before that. And so we see here markets moving down in a downwards a downwards wedge. So we don't start to buy in a downwards wedge because we haven't found support, because we don't have any line here going through telling us we've got support. It's not till down here, so you ignore it. And then here, the reversal pattern, again, middle of the range. Moving average, again, could then come into play, because once we close above the moving average and hit the resistance points again, when we start to run out of ideas, the overall trend then continues, but then maybe we have to sharpen up the RSI. I mean, this is what's really difficult, because it's all down to absolute interpretation. At the end of the day, the individual candles are going to give you an idea of what's happened in the past. Okay, down. So this is down. We don't buy. Okay, we're going up now. Reversal. But again, think about the overall picture. Support and resistance. But again, you have to figure out what the RSI indicators, moving average are doing to build that rounder picture of what you're trying to achieve. So again, I guess the more oscillators you use, the clearer the picture is going to be. The individual candles for me are something that can be a massive help or a massive burden. What I would say is that if you're looking at candles day in, day out on the 5-minute, 15-minute, and hourly, you're going to get an idea of how things can change and how things can change in a way you can understand, and then you can replicate it with a line chart, a bar chart. You can't do that. So for me, it's all about understanding individual candles, patterns within patterns, and the bigger picture, and understanding how the indicators, oscillators, all kind of trade around that. All right, guys. Any thoughts? Any questions? I guess I could literally talk about candlesticks all night. Literally for hours and hours and hours. This is meant to be an idea just to make you think about the individual components, the cluster components, all the different things really make up why markets move and how markets move. And that's really what we're trying to figure out. Why markets move in the way they do, and then little kind of snapshots of information that can make all the difference. Well, again, the big things tomorrow, guys. Non-farm payroll is tomorrow. I'm going to start at 1 o'clock. The biggest piece of information, the last piece of information of the year, apart from the Fed meeting, and it's gonna be massive, guys. So if I can teach you anything, I'll teach it all tomorrow live. And I'm not gonna lie to you, marketing's been very difficult for me over the last few weeks, but let's figure out what they are together, and let's figure out the kind of what the individual candlesticks and these continuation reversal patterns can mean in real time, and that's what's going to make you a better trader. Alright guys, well, anything else, get me on Twitter at SteveRuffley. If not, my email, it's sruffley@tradermaker.com. Alright guys, well listen, been a pleasure, and please join me tomorrow at 1 o'clock, because that'll be the big one. Alright guys, cheers.